Good day, subscribers. Thank you so much for joining me today. I am Jeremy. This is the Financial Education Channel, and today we're talking about the stock market. What is the stock market? Stock market, for people that you really don't have a clue on what the stock market is, how it works, those kinds of things, or maybe you understand just a teeny bit, but you're very confused about the stock market. I am going to share with you guys the 10 most important things you got to know as someone that's trying to understand the stock market. I'm going to break it down in the most simple way possible. And if there's one thing I'm good at in life, it's taking a very complex subject and breaking it down to be very simple and very easy to understand those kinds of things, guys. So that's what we're doing today. I'm going to give you the 10 biggest things that, as someone just trying to understand the stock market, you should know so you can understand it, guys. So hit that thumbs up button if you enjoy today, and let's get into this. Number one. The stock market is basically a global electronic network where you, as a person, can buy ownership in companies. You can buy ownership in public companies. So basically, and we'll kind of go through some more steps in here and whatnot, but that is the basic premise of what the stock market is. It's an electronic global network where you can actually buy ownership, which is called shares, ownership in an actual public company. So, and by the way, the difference between a public company and a private company is a company that's listed in the stock market, that's gone public and all those kinds of things that you can actually buy shares into. A private company is a company that is not on any type of stock market, and you cannot buy shares, you cannot buy ownership in that company. Like, for instance, my real estate marketing company, that's a private company. You can't buy shares in that unless you know me or something and I'm willing to sell shares in that. Public company, it doesn't matter who you are. You can be anybody and buy shares in that public company, guys. So that at its most basic form is what the stock market is. Now let's get into a lot more of these simple things. Number two, some companies go public to raise money. And sometimes the owners will sell shares to raise some money for themselves, right? So basically, that's why some companies go public. They want to basically sell off some shares in that company and raise capital. So which means they might get hundreds of millions of dollars, they might get billions of dollars depending on the valuation, and they can use that money to then expand their business and some of those sorts of things. So then the investors buying in, with their money, that money ends up going to the corporation. And the corporation can then use that money to build out facilities, all these things to expand the business, use it for marketing, advertising, all those kinds of things, whatever the company wants to use it for. And then also some of the owners, right? Some of the owners, they'll usually sell a bunch of shares as well. They might not sell all their shares, they might only sell a portion of them. But they sell that also in the IPO process. That way they can have a bunch of money around because they might have not paid themselves a salary for a long time. They might want to go buy a mansion. They might want to go buy a 75-foot yacht with the money or whatnot. Because unless they sell some of the shares, then they don't really have any money, right? Because all their I guess you could say net wealth is built up in that company. So someone might be a billionaire technically, because their shares are worth something, but they might not have any money to their name because it's all wrapped up in those shares. So until they sell some shares off to you as another person, they get some money for that, and then they can go, do whatever they want to do or buy whatever they want to buy and some of those kinds of things, guys. So that's why some companies go public on the stock market, raise capital, and some of the owners just want to sell some shares to diversify their wealth or go out and buy stuff and things like that, guys. Number three. When a company wants to go public, they have what's called an IPO. You guys may have heard this term before. An IPO stands for an initial public offering. That's what happens when a company wants to go public and become a public company that's traded on the stock market. They have an IPO, basically a bunch of investment banks do it and whatnot. They try to make sure it goes as smooth as possible in that they have a lot of pent-up demand from investors wanting to invest in that company, and there's that very first day it begins actually trading. And like I said, usually tons of investment banks and whatnot are involved with this. Companies like Goldman Sachs, JP Morgan, some of the biggest, Morgan Stanley, they're all involved in this process, most of them, and they are basically trying to make sure it's a smooth transition as possible from a private company to now a public company, and it all happens within a day process. But the buildup will take sometimes months, and basically the owner of the company will go on a roadshow. They'll talk to potential big investors, net wealth, high net wealth type people, and say, hey, this is why you should invest in my company. We're doing this and this and this and this, and then they get a bunch of demand up, and then that initial public offering happens, and then it's a public company after that. Number four. If you want to invest in a public company, then you have to have a brokerage account. So if you, as an investor out there, you want to buy, let's say, Apple's a public company, right? Say you want to buy Apple shares, you have to have a brokerage account open. Now, there's lots of different ones you can have. There's like Fidelity Investments, there's TD Ameritrade, there's Scottrade, E-Trade. There's companies like, I heard Robinhood app. If you type in Robinhood, I heard that's a very good app, and I believe they do not even charge you to basically trade and buy shares and whatnot. You have to have some type of account like that where you can then buy shares in a company, sell shares in a company, those kinds of things, guys. You have to have an account open, and basically that account, you just link it to your bank account, right? And then you can just basically funnel your money from your checking account into that account where you can then invest and buy stocks and some of those kinds of things. Number 5, you can buy shares in a company you believe in. There's a lot of different things you can do in the stock market, but that's going to be the biggest one you guys as beginners want to do. You want to buy shares in a company that you believe in. You believe in that stock. You believe in Google stock because of whatever reason you believe in it and those kinds of things, and you've looked into the company and whatnot. That is why the majority of people are in the stock market. They're in it to basically place a bet, buy shares in a company, and hope that those shares are going to go up over time and make money off that. So then for beginners, that's almost every beginner out there. That's what you're trying to do. You're basically just trying to buy shares in a company. And by the way, if you're doing that, that means you're bullish. You're bullish on a stock. That's just a term that a lot of people use. You're either bullish on the stock market, or you're bullish on a particular stock. And if you're bearish, what bearish means is like, it's like literally the opposite of bullish. You do not believe in the stock. You do not believe in the stock market, some of those kinds of things. So understand bullish, understand bearish. If you're trying to buy shares in a company because you think they're going to go up, you're bullish on that company. If you're out of the market completely, or you're trying to short sell stocks or something like that, that means you're bearish on the entire market. So just kind of understand those two terms because they're thrown out there a lot when in general, and if you don't understand them, you'll probably be lost. So number six, you make money. You make money in the stock market when you buy shares in a company, and then when you go to sell those shares, they're at a higher price than you bought it at. It's as simple as that. So let's say you bought one share of ABC company at $10. You bought one share at $10. And let's say that share, you can sell it at any point in time. Let's say you held it for a year or whatever. And you're like, okay, now I want to sell it. And let's say that share is at $20 at this point. So that means you made a $10 profit on that because you get your original $10 back, plus you made $10 in profit. So now you have $20 that you can either invest in something or just pull the money out or whatever you want to do at that point in time. But you have to actually sell those shares to make that money. So up until that time, you're just technically up on a position, but you have not actually made the money until you go in and sell it. Now, how you lose money, point number 7, how you lose money is if you sell a share for a lower price than you bought. So let's say you bought that one share in ABC company at $10, and then for whatever reason, you're like, the stock's going down, I don't like it, whatever, or you have to sell it. So you go ahead and sell it, right? And let's say it's only at $5. Then you lost $5 of your investment. Now you're only getting $5 back when you had originally put in $10. So that's how you lose money in the stock market. And once again, you never are technically lose the money until you go to sell it. So if it was just down to $5, let's say for instance, and you don't sell it and it bounces back, then you never lost the money. But if you sell it at $5 and get out of it and take your money and run, then you lost your $5 then and there. Number 8, companies report earnings every 3 months. This can move stocks up dramatically or down dramatically or not even move them at all. So basically what happens is every 3 months, pretty much every single company out there, they'll report earnings. And basically when they report earnings, they're going to say everything good that happened with the company in the last 3 months, everything bad that happened with the company in the last 3 months, what the forecast is, what the company's looking to do for revenues for the next 3 months, maybe the next year, those kinds of things. And based upon what those results are, that can move a stock up a lot, down a lot, or it might just not move it at all. We just don't know. It's like, for a simple analogy, let's say we're placing a bet on the Green Bay Packers, right? We think the Green Bay Packers football team, they're going to win the Super Bowl next year. And they got so much talent and this and that. And we're like, okay, so we put our money on the Green Bay Packers. And let's say we don't know what happens with the Green Bay Packers until they report 3 months later. And so 3 months later, they report, and the report comes out, and the Green Bay Packers are 4-4, so they lost 4 games and they won 4 games, and Aaron Rodgers was hurt. And that's what the report is. What do you think would happen to the value of our little ticket that we're trying to, take the Green Bay Packers to the Super Bowl? It's going to go down dramatically because they're not doing good at all. Their main quarterback's hurt. That's the same thing for companies. They're going to report those numbers. If they don't come in as expected, like the Green Bay Packers thing, they should have been like 7-1 or 8-0, and and Aaron Rodgers is healthy, right? And that would have made that ticket more valuable. If that happens with the stock, they report really bad numbers and things, those shares are generally speaking going to go down, and going to go down drastically. If they report really good numbers, things that were expected, then that stock can definitely go up, guys. So that's what happens in a quarterly report. Happens every 3 months, the company reports numbers. Very important. Number 9, every share owned in a company represents 1 vote. And with that 1 vote, you can basically decide the board of directors. Every single year, there's what's called a shareholder meeting. So depending on how many shares you own, you have that many votes in a company. And you can then help decide, if this guy's on the board of directors, this guy's on the board of directors, or this gal's on the board of directors, those kinds of things, guys. So now how the structure of a public company works is you got the board of directors at the top. Board of directors is usually like 4 to 10 of them, depending on the company. So you got the board of directors at the top. What the board of directors does is you, as a shareholder and owner of the company, you vote on who those guys and gals are. What their job is not to necessarily decide where the strategic company is going, what products and services they come out with, those kinds of things. They're basically deciding who's a CEO, who's a CFO, who's a CEO, who's all the executives that are going to make those type of decisions. That's their main job, and decide on executive compensation, all those kinds of things. The executives, those chief executive officers, CFOs, all those super important people, they're technically below the board of directors, but they're the ones that decide how strategic the company is, and as far as new products, new services, what type of new industries they get into, and then under them is all basically everybody else. So that works for the company. So that's how it is. You as the owner over here, you decide who's the board of directors up here. They decide who's going to be the CEO, CFO, COO, all those kinds of things. So that's why it's very important for you to pay attention to who's on the board of directors, because you want people that are going to make good decisions, that are going to pick great executives to then go ahead and run your company, because the decisions those CEOs and those CFOs make, those are going to make or break your stock long term. They're going to either make great decisions and your stock's going to go up dramatically, or they're going to make really bad decisions and your stock's going to go in the tanks. So they're the ones that are going to decide. Number 10, last point here, guys. The American stock market is open 6:30 a.m. to 1 p.m. Eastern time, Monday through Friday, and it's closed generally for all major American holidays, 4th of July and some of those, Memorial Day. And then also it's closed for a lot of the Christian holidays, because America is a little more of a Christian nation, so that's just the way it works. Closed for more of the Christian holidays, closed for a lot of the big American holidays, but open 6:30 a.m. to 1 p.m. Monday through Friday, and that's when you can actually trade shares back and forth. If you want to sell shares, you can sell shares at that time. If you want to buy shares, you can buy shares at that time, but it's got to be during those time periods, guys. So I hope this helped you immensely. If you didn't have any clue about the stock market before this video, what the stock market is, I hope it helped you, even if you had a little bit of knowledge about it and just kind of understanding it, understanding the fundamentals of it and the 10 biggest things. Leave me a thumbs up if this video helped you out, and leave me a comment if you have any questions. I would love to hear from you guys in that comment section. Anyways, thank you for watching. If you just came across the channel, you may want to subscribe. We talk personal finance. I'm an actual business owner. We give away so many business tips on this channel, and we talk the stock market, the most of everything, just like we did today. Thank you for watching, guys, and have a great day.